Energy-driven inflation is colliding with an AI capex boom and a blockbuster SpaceX listing, forcing equities to reassess who really wins from this cycle. Welcome to vTalkInsight, Equity Pulse Daily for June 12, 2026. Let us start with the macro backdrop, where producer prices in oil are quietly resetting the policy conversation. May producer price inflation came in hotter, with headline PPI rising 1.1% month-on-month and 6.5% year-on-year, the firmest back-to-back prints since early 2022. Goods prices jumped 2.8%, driven by more than a 10% surge in energy, showing how the oil shock is feeding straight into corporate cost bases. What is more concerning is that recent data show pressures spreading beyond fuel into industrial materials and chemicals, hinting at more entrenched cost inflation. Headline CPI and PPI remain elevated, even though core inflation is holding closer to 2.5%, suggesting underlying forces are less extreme, but still not comfortably at target. Against that backdrop, the European Central Bank has just delivered another 25 basis point rate increase, while projecting euro area inflation above its 2% goal until late 2027. Officials concede they are near the upper end of neutral, yet argue that not hiking would be the bigger risk if inflation expectations were to drift, so policy is edging deeper into restrictive territory. In the United States, 2-year Treasury yields have pushed above 4%, and the curve now embeds roughly 40 basis points of additional Fed tightening, even though the base case for this year remains a policy pause. Further out, some scenarios still flag the possibility of a 50 basis point hike between 2026 and 2027 if inflation does not cool, especially with persistent oil-related pressures and structurally higher capital demand. The macro mix is tricky. The ECB expects only moderate euro area growth around 0.8% this year, while in the U.S. structural supports like AI investment and government spending keep activity resilient, even as lower-income consumers struggle with negative real wages and depleted savings. For equities, that combination of higher nominal GDP and sticky prices favors real asset and cash flow-rich areas such as energy, materials, and large-cap value, while extended duration stories and rate-sensitive segments like housing and parts of airlines face more pressure from elevated yields. Despite the inflation noise and geopolitical stress, equities have shown remarkable resilience. The S&P 500 just snapped a multi-day slide with a roughly 1.7% gain, while the VIX has eased back from above 22 toward the high teens, signaling risk appetite is returning, but nerves are still close to the surface. Geopolitics remain a key swing factor. U.S. equities have repeatedly rebounded from 5-week lows on headlines suggesting a pause or de-escalation in U.S. strikes on Iran, with defensive sectors such as consumer staples lagging whenever hopes of an Iran deal push investors back into cyclicals and growth. Underneath that resilience, several late-cycle warning lights are flashing. One framework now counts around 70% of typical pre-peak bear market signals as triggered, while valuations show high PE growth stocks strongly outperforming cheaper names, a pattern consistent with a speculative phase that can be vulnerable if earnings surprises roll over. Market concentration adds another layer of risk. Technology and adjacent growth stocks now make up well over half of the S&P 500, yet many of the mega-cap names, including the so-called Magnificent Seven, are negative for the year and well below their highs, even as the headline index masks the weakness in a large fraction of its constituents. Credit markets, by contrast, still look benign, with high-yield spreads around 2.7% suggesting little immediate stress, and names like SpaceX refinancing from double-digit coupons to mid-4% investment grade levels. That tightness supports the bull case of ongoing expansion, but it also means any shock to oil, policy, or earnings could reprice both equities and credit from stretched starting points. The core equity story remains the sheer scale of AI-driven investment. Estimates now put hyperscale AI infrastructure capital expenditure at up to $1.4 trillion this year and potentially around $2 trillion annually over the next 5 years, as companies race to build data centers, network capacity and power generation to feed insatiable demand for advanced chips like H100s and the next-generation GB200s. Physical infrastructure is becoming the binding constraint. Roughly a quarter of announced data center projects are failing to deliver, and power supply is seen as the main gating issue, which is why players like Helix Digital Infrastructure and Digital Bridge are amassing multi-gigawatt portfolios and partnering with utilities such as Vistra to secure dedicated energy for AI workloads. However, the Oracle episode shows that markets are no longer rewarding AI spending for its own sake. Oracle's shares fell sharply, at one point more than 10%, after investors focused on data center capital expenditure that could reach the equivalent of its entire revenue base, overshadowing solid growth and guidance and raising real questions about near-term profitability and competitive positioning. We are also seeing a clear split within software. Companies like Datadog and Snowflake that are embedding agentic AI to automate workflows are enjoying faster growth and high revenue multiples in the mid-teens to mid-20s, while legacy software and some Chinese internet names are underperforming amid weak earnings, limited AI exposure, and regulatory overhang. On the hardware side, semiconductor sentiment has stabilized after recent volatility. The Philadelphia Semiconductor Index has jumped on optimism around the SpaceX listing, Oracle's capex impulse for chips, and a double upgrade for Intel that highlighted underappreciated server and foundry potential, while in Europe chip and hardware names are outperforming slower-growing software as industrial groups like Bosch pivot toward AI-powered sensors and robotics. The immediate focal point for equity supply is the SpaceX initial public offering. The deal is raising around $75 billion at a valuation north of 90 times current or forward sales, with retail orders exceeding 70 to 100 billion and total demand reported at more than 4 times the offer, underscoring extraordinary appetite for high-growth, AI-adjacent assets. SpaceX has also completed a remarkable credit re-rating, refinancing roughly $17.5 billion of high-yield borrowings into a $20 billion facility at investment grade-like pricing near 4.6%, all while running a low-leverage, cash-rich balance sheet. Yet the IPO structure grants Elon Musk near total control, with limited independent oversight and related party transactions drawing governance concerns that could see some large asset owners seek index products, excluding the name. More broadly, the surge in mega-cap tech listings from SpaceX to potential deals in OpenAI and Anthropic, alongside large secondary offerings by high free cash flow companies, is reversing years of public equity shrinkage. That heavier supply, combined with accelerated index inclusion and passive flows into new AI benchmarks, raises the risk of rotation out of existing tech leaders and makes liquidity, rather than just earnings, a central driver of equity pricing in the months ahead. Pulling it all together, equities are caught between energy-led inflation and tighter central banks on one side and powerful structural growth from AI infrastructure and space-related investment on the other. Producer prices in oil are keeping policymakers on edge just as lower-income consumers show signs of fatigue, yet credit markets remain calm and earnings beats are still supporting the broader bull narrative. Within that backdrop, leadership is rotating. Semiconductors and hard infrastructure are regaining ground, high multiple software and some mega-cap tech names are under greater scrutiny, and the SpaceX IPO is testing how far markets are willing to stretch on valuation and governance to access perceived long-duration growth. The key things to watch now will be the next inflation and wage data, central bank communication around balance sheet and terminal rates, oil supply developments in the Strait of Hormuz, and company guidance on AI returns versus capex, especially from firms following Oracle's path. Flows around the SpaceX listing and the broader AI IPO pipeline will also be critical signals of how much incremental liquidity is left for equity risk. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.